Hello, welcome back guys. In this video we are taking a look at Shopify, which is crashing it today. It's up about 8% as you will see. If you take a look at the 3 years though, you will kind of see that at some point Shopify was sitting at about like $170 almost. And then it started going downwards, and the 1 year high is actually less than 100. So imagine that. The 1 year high was actually sort of like over here, and it's still going down, and it has lost about 80% from its all-time high. So it may be an interesting opportunity, this kind of company, which is very, very well known, and I do believe in it. I think it's going to be one of the key players of the future. But is it a buy? Because again, the stock is different than the actual company. Is the stock cheap enough? Does it make sense for us to buy? This is what we're going to examine in this video, and actually see see the final details and actually analyze the company to its core. Okay, so the P/E ratio of the company is sitting at 300 right now, more than 300. You can kind of see it going up and down quite a lot. Now, if you take a look at our metrics tab over here, and this is where I like this sort of layout here, you can very, very quickly see that the net income margins right now are negative. So that doesn't make sense. Why is the P/E ratio positive here? The P/E ratio is positive because it has to do with pretty much the previous year. And this net income margin is actually going through the quarters as well. So you can kind of see the drop, the pretty much the precipitous drop over here in the past, in the more recent quarters. And this tells you the story pretty much of the company. It tells you, just by looking at this, that the company was expensive at some point, and then things happened with the net income. It started going downwards. And you can kind of see here, this is taking you through the fiscal years, that the net income of the company was positive. But again, with the margins going down, you already know that the quarters are gonna be ugly here. And we will examine this in more detail so that you see how this pretty much over you can tell us the story of the company right now very, very quickly and easily. Now, in the overview, you can see that this is probably already quite expensive here. 300, 120 already looks expensive all over the place. It's not normalized. It's going up and down a lot. Even though the price to free cash flow is a little bit better over here, it's still going up and down a lot. You can kind of see this is 1,000 over here, so you can kind of imagine what the difference, the discrepancy is. Now, the company doesn't have a lot of liabilities, doesn't have a lot of debt, as you'll see here. They are mostly making money from issuing shares, as you will see. And this is obviously a pretty bad thing to see for a company. As a stockholder, that is, you don't want them to issue shares, although it makes a ton of sense because over here the company was extremely expensive, and the board, understandably so, wanted to make money out of this, and so they were issuing more and more shares, and this is why the float is actually up more than 30%, and so investors have been diluted. You kind of feel it eventually. The stock is down 80%. So at some point, all these things matter, especially the performance of the company, and it kind of brings you down to from 160, 170 almost to less than 50 over here. But what is going on with the actual numbers, the thing that I talked to you about earlier? You can kind of see here the fiscal years. 2017, 2021, the company has been increasing the revenue from less than $1 billion to 4.6 billion. So very, very nice increase here. The same thing with the net income has been increasing, as you'll see, from negative territory to very positive territory to 2.9 billion. So things are looking great. But we do know that the net income margins pretty much fell down. They went to negative territory. So if you take a look at the quarterly, you will see that the fiscal year hasn't been complete, but the net income has been down for these past 3 quarters over here of fiscal year 2022. And this is why you are looking at net income margins being suppressed, even though the previous fiscal year things were looking pretty solid over here. And so this is something very, very important, and you may be wondering why this is happening. And you can kind of see it over here in this very interesting article that I was reading earlier about Shopify, why it lost a lot, pretty much, of its value in December, that is. This is a little bit earlier, like a month or so. And you can kind of see here that, like many retail-oriented companies, Shopify beefed up capabilities in 2021 to handle a huge surge in demand. 2022 came as a shock with rising inflation and matching interest rates, sending sales growth lower. And Shopify was left with resources and expenses it didn't need that drained its profits, and this is what happened over here. And it's still posting double-digit growth. Sales increased 22% year over year in the third quarter, that is. Again, remember when we talked about the third quarter fiscal year, and there were many other positive signs, such as increases in monthly recurring revenue. Net loss, however, came in at 158 million, pretty much after a 1.1 billion profit last year is what we kind of saw in the most recent quarter over here. So yeah, we do know that 158. And so yeah, we are seeing what is happening and we are seeing the story. So why is it up more than 8% today? And the reason for this is pretty much the stock jumping after Deutsche Bank's upgrade, which adds to sort of like a bullish chart action if you are into technical trading. But the most important thing is the Deutsche Bank's upgrade, and also I would say that the fact that pretty much the market has been very positive today. The Nasdaq and everything has been gaining, and so this obviously affects it. And the fact that it has lost a lot of its value in the past, that also helps a lot. Now, if we take a look at our financial statements in a little bit more detail here, for instance, the balance sheet, you will see that the company's total equity has been increasing massively from 1 billion to 11. But remember, the company has been issuing a ton of shares. Now, the total liabilities have been increasing at the same pace, which is nice to see. And again, remember, we examined it earlier, the liabilities that the company has compared to the equity that they have. They are like 0.2% or something of that sort, so it's 0.2, so it's like 20%. So it's very little compared to the total equity that the company has, which makes for a pretty solvent company. Now, in terms of the cash flow, and again, it's the same story here, positive net income, positive operating cash flow, but again, if you take it to the quarters, and this is when things go a little bit dire, sort of, and you will see here that we are sitting in negative territory, and again, negative in terms of free cash flow. But it's always important to examine the annual periods as well, the annual, pretty much the fiscal years, because it tells you the story of the company. It tells you how the company has been proceeding through the years. And the past few quarters could tell you part of the story, but you do know that part of what happened has a lot to do with the current situation in the markets. And this has been the same effect has been played out in many companies. So it's not something that you should be too firm about, and you can kind of leave a little bit of a leeway there. And it's important to note what is happening, but it's important to also understand why it is happening. And we do know that this was an extraordinary, pretty much, year, and the past few quarters have been extraordinary. But this can kind of tell you the story of a company that has been increasing their free cash flow, going from negative to positive territory. So it's a company that has been having some very, very positive signs. Now, the thing is, okay, we do know of all these, and we kind of examined the company in detail. Now we know exactly what is going on. But what is the company worth? So even taking all this into account, what is the company worth to us today? And of course, we're going to be using our stock evaluation tool, which always can tell us the story of the price, pretty much what it makes sense to be paying for the company. Now, the revenue that the company has been achieving through the past 5 years, 3 years has been tremendous. You can kind of see it here, growing tremendously from less than $1 billion to almost 5. And we do know that likely the company is going to be growing at double digits in the upcoming years. So I am willing to go 10, 15, and 20, which is a high growth company, obviously, for the next 5 years. I think the company could achieve that. Now, the net income margin is a little bit of a different story, because for 3 years over here, the company was negative. And then they had pretty much the odd one outs over here, as you'll see. Now, this one looks a little bit more normalized. 2021 over here, the margins were, have skyrocketed. Maybe this was from a one-off sale or something of that sort. But something like 10, 11% probably makes way more sense for when the company goes back to positivity, pretty much. So I will use something like 10, 12, and 14 here. Now, we don't really know what the company is going to be doing, of course, in terms of net income margins. We don't have enough data to deduce what the company could be achieving in the next 5 years. It's not easy to say for sure. So I'm going to be using something like that, like 10, 12, and 14%. And of course, this is the whole purpose of the tool. You can use different scenarios and see what it makes sense for you to pay today. This is what we're doing here. And in terms of the free cash flow margin, I'm going to use something like 80, 90, and 100, the typical thing that you see in many companies pretty much. And the annual return, about 13%, is what I want to be making out of any single stock. And pretty much this is the discount rate that I'm going to be using. And if I hit calculate, you will see that we're sitting at a rate of about $5 to $15 over here, with revenue growth of 20%, that is, we're sitting at $15. Now, again, the margins here could potentially rise even more, so let's see what happens if that is the case. Let's see, we are actually achieving, the company achieves 20, 22, and 24 in terms of net income margins. What then? What's going to be happening then? in that case, where it could make sense to even pay something like $25, 20 to 25, it would make sense. And I think for this kind of company, for Shopify, it could make sense to be buying this one at about 15 to 20 bucks, something of that sort. But where it's sitting right now, 43, I think it's still expensive. Now, you may be wondering, this has gone down so much, could it go down more? Well, it could. It definitely could. It really depends on the overall market. But the thing is, you definitely want to be grabbing a value at a good price. Now, is this a good price? I don't think it's there yet, but it does have some merit, this company, the fact that they have been doing pretty well before the pandemic hit. You can kind of see it here, but it's still expensive, and you can kind of see it over here. Now, back in 2021, at some point, maybe things were better. Right now, as the profit is dropping, it looks like it's still rather expensive for what it is and what the company has been doing through the years. So I would add some caution here, and consider it again if you are looking into looking to investing in Shopify. It may be an interesting opportunity, but it probably requires a little bit of a better price. And if I would be lucrative, maybe I would pay like 30 bucks. But 43, I think it's still quite expensive, so probably I would avoid paying this one. At some point, it was actually near 30, as you'll see over here. So over here, maybe it would be a much better, suggestion potentially. Over here, you could potentially see someone buying it, and maybe considering it at least. Yeah, it was at a much better price over there. That's what I wanted to tell you, and pretty much that's what I wanted to analyze in terms of Shopify. We kind of saw the whole story of the stock over here. If you're interested in this kind of analysis, and if you want to do your own analysis, of course, all our patrons have access to this tool that I'm using over here, which has a ton of other modules over here, and I'm adding more all the time. And if you want to gain access to this one, you can become a patron. All the links in the description box below this video. And thank you for watching. If you like this kind of videos, you may also want to take a look at AMD, which is another interesting case. I have made a video about it. Take a look at this one now, and I'll see you soon. Bye-bye.